everyone. I'm Bret Mooney, and welcome back to Mooney Talks Money. Today, I'm going to be talking about or focusing on opportunities in equity markets, and in particular, small and mid cap equity markets. Many investors look at the S&P 500 when they're looking for an indication on how the economy is doing or how markets are doing, right? Well, that index in particular is roughly about 500 stocks, all large cap stocks within the economy, right? So although it is a pretty good indicator, right, it doesn't really reflect the overall 3,700 plus stocks that are out there, right? That really only represents about 500 names that are in the market, right? So in a representation, right, is really only covering about, right, 20% of the total stock market in terms of what's out there, right? So to start, I just want to focus on what's the difference between small, mid, and large cap companies, right? And the first is small caps, right? So it might not be as small as you think, but small cap companies are defined as having revenues from $250 million to $2 billion a year, right? So pretty nice sized companies, but they're considered small caps, right? A mid cap company has revenues anywhere from $2 billion to $10 billion a year, right? So you're starting to get pretty big in that scenario. And then the large cap companies are companies that have 10 billion or more in revenue per year. Now, there's a fourth kind of mega cap. It's called large mega cap stocks, right? Companies with over $200 billion in revenue. And that S&P 500 indicator is all of those large cap stocks and has a lot of exposure to mega cap stocks, right? Well, we've seen a nice kind of run up in large cap stocks this year. So I wanted to focus on opportunities outside of that in particular. So I'm going to share my screen just to give you an idea of historical performance really since the beginning of well, not since the beginning of time, but going back to 1990, right? So 30 plus year period, right? If we look at all of these different asset classes that are out there, on the right-hand side, you can see that you got US large cap growth, you got large value, mid growth, mid value, small growth, and small value, right? So all those different asset classes that are out there. And as you can see over time, right, when you look at the growth of $10,000, you might be surprised to see that mid cap companies actually outperform any of the other asset classes, considering large caps and small caps. In particular, the highest performing asset class being mid cap value. Right. When we talk about diversified portfolios, right, it probably makes sense to have a exposure to each of these asset classes. In order to outperform any one asset class, typically you want to have a combination of all of those asset classes, which is kind of a case for diversification. But I'm not going to be spending my time on the diversification side of things today. I just want to talk more about opportunities that are out there right now. And the reason for showing this is because many times people get a recency bias, right? For the last 3 or 4 years, large caps or the S&P 500 has really been the best asset class out there. And you've had the best performance in those asset classes for the last 2 or 3 years, right? Well, if we look over time, right, you actually would have made the most money in middle and small cap type companies, right? Particularly small and mid value companies. And the reason I point that out is because we've seen a huge run up in large caps, and many times for your S&P 500 investors, right, they don't want to decrease exposure there, right? Because they may think diversification actually means less return in those scenarios, but that's not necessarily the case, right? You can see that if you held any of these asset classes, actually owning U.S. small value companies and U.S. mid-sized value companies have done the best for you, right? So I just wanted to illustrate the growth on those asset classes over the last 30 years or so before getting into the next piece of what I wanted to talk about today. So that's one side of things, right? So that's kind of the long-term picture of those different asset classes. So I'm going to spend a little bit of time and just go through what we've seen over the last 12 months, right? And over the last 12 months, I'm going to share my screen to a different screen now. And over the last 12 months, this is what we've seen in these indexes, right? So the S&P 500, the one that you're probably most familiar with, right? It's up almost 15% on the year over the last 12 months, right? So we've had a pretty nice recovery in that asset class, right? But I want to compare that to what we've seen in small and mid cap companies over that same time frame, right? If we look at the S&P 600, right, which includes all the small cap stocks in the market, over the last 12 months, small caps are actually down 3.7%, right? So they're a negative 3% when large caps are up almost 15, right? If we look at middle-sized companies over the last 12 months, right, they've only had a return of about 1%, right? So you can see that middle and smaller size companies over the last 12 months, right, have really underperformed those larger size companies, right? Well, why is that, right? Well, the biggest reason is interest rates, right? So when we look at the interest rate environment, your smaller and middle-sized companies are more dependent on financing to run their operations. So those smaller and middle-sized companies that are having to finance their debt to run their operations, it's a lot more expensive for them to do that in a rising interest rate environment, right? So we've seen the profitability of those companies hurt over the last 12, 18 months or so, right? Those larger companies that have huge cash positions, maybe don't need to finance as much debt, they're able to run their operations more to normal versus those smaller and middle-sized companies, right? Well, hey, Bret, we don't know what the interest rate environment looks like, right? So should we stick to our exposure in large caps, or should we have exposure to middle and small size companies? Well, my answer is you probably want to have a combination of all of it, right? But for those of you that may be trying to time markets or looking at indexes, right, now's a pretty good time to reallocate some of your large cap exposure into your small and middle sized companies, right? And why do I say that? Well, one, right, small and middle sized companies have underperformed or in the short term, right, over the last 12 to 18 months, right? So just from a fundamental perspective, right, hey, these asset classes are cheaper than large caps, right? So we want to purchase this. But even more to that is our expectations of interest rates, right? So I've had a previous call where I went through the CME Group's Federal Reserve Watch tool. But to my point about companies needing those smaller companies being more expensive to finance their debt and to run their operations, we see that environment turning as we move forward over the next year, maybe 2 years, right? And here's kind of why we think that, and the Federal Reserve is telling us this too. There's a possibility that they raise rates, right? But it's very low in the short term, right? So there's like a 98% chance that we're not going to raise rates here in December. But what I wanted to illustrate is if we look further out, like towards the middle of next year, right, we actually start to anticipate rate decreases, right? So the data is kind of illustrating right now that we may have 1 to 2, maybe even 3 interest rate cuts by the end of next year, right? And if that happens, your smaller and middle-sized companies, right, they are able to operate in a more efficiently, right? They're financing their debts at a lower interest rate. Their profitability is better. In turn, their growth is going to be a little bit better in that environment, right? So not only do we think small and middle-sized companies are undervalued, but we're expecting interest rates to decrease over the next 12 to 18 months, which is going to accelerate the profits and the earnings of those companies over that time frame as well, right? So we think there's a unique opportunity in small and mid-cap spaces, right? And if you're not in a diversified portfolio that doesn't have exposures to small and mid-caps, you should seriously consider adding some exposure to those asset classes in particular. That's all I had for today with Mooney Talks Money. If there's any particular topics you guys would like me to discuss or go through in future meetings or in future calls, let me know. Leave a comment below. Thank you.